Hi there folks, Mike Kinnett here from Prostatis. Welcome back to the channel where we help simplify retirement and show you how to keep more of your money, protect what you've earned, and set up a retirement plan that actually works. Today we're going to dig into new 401k opportunity that high income earners and retirees, savvy millionaires are already taking advantage of thanks to the lesser known rule in the Secure Act 2.0. If you're between the ages of 60 and 63, 2025 could be your biggest year to catch up yet and potentially supercharge your retirement savings. Let's break this down. Understanding the new 2025 catch-up rule, under Secure Act 2.0, pre-retirees between age 60 and 63 will be allowed to contribute an additional $11,250 to their employer-sponsored retirement plans, like 401ks, 403bs, on top of the normal standard limits. So what does that mean for 2025? Well, the normal limit is $23,500. But catch up, we have a catch up for people ages 50 to 59. They can put another $7,500 on. And here's where it gets even better. The enhanced catch up provision for people aged 60 to 63, we can throw another $11,250 into our retirement accounts. This means you could potentially stock away as much as $34,750 into your 401k in 2025 alone. So this enhanced contribution is incredible. For our clients that are pre-retiree, that are getting into this retirement age, that we've sat down and we've created these plans, imagine being able to sock away that much more money into a Roth IRA. Imagine being able to get $34,000 plus into a Roth IRA every single year. And I recognize it's really going into the 401k, but when we retire, we're gonna be able to roll that money into the Roth IRA. So for us, this is an incredible opportunity to sock away a ton more money into tax efficient accounts where we get to control the tax implications today, but we also get to look forward and control the tax implications later. And it makes sense to take advantage of it, even if all you're doing is put it into the Roth 401k, even if all you're doing is put it into the traditional 401k. Put that extra $11,250 away. If you can afford to do it, it's gonna make a difference for you, it's gonna make a difference for your beneficiary, and it just opens up the flexibility as you go through retirement. Take advantage of it while we can. So let's put this into practical terms. Let's say you contribute the full $11,250 extra each year from age 60 to 63. That's 4 years of contributions. That's $45,000 extra. Think about the compounding effect of that. Let's assume we get a 6% return over the next 15 years. That extra $45,000 could grow to almost $84,000. That's huge. That's huge. That's real leverage. Compounding effect of this money is incredible. Now, if you've got questions on how to apply this to your own situation, drop them in the comment box. We're always here to help walk you through it. Now keep in mind, this is a window. While the law is active now, which is why we have to take advantage of it now, it's unclear how long these expanded contributions are actually going to last, especially with ongoing tax reform discussions and economic uncertainty. The window to take full advantage of these may not be open forever. And remember, this only applies if your employer allows catch-up contributions, especially Roth catch-ups. And remember, starting in 2026, those pesky tax rules, they change. And those of you earning over $145,000 a year, you may be required to make those catch-up contributions as Roth only, meaning post-tax. That's because they want your money now. They want that tax money today. So make sure to subscribe and hit the like button below. If you're finding this information helpful, we're here to simplify what Congress tends to complicate. So what should you do today? What are the action steps you can take away from today? If you're eligible and still working, max out your standard and enhanced contributions in 2025. It is a no-brainer. Check to see if your employer matches you. This is free money that you do not want to miss. Why would you give up free money? Make sure you're maximizing to get that match in the contributions. Review your investment mix to make sure your 401k still aligns with your goals. Ask about Roth catch-up eligibility and the tax implications. These are all things that you should be thinking about today, and quite frankly, they're things that you should be discussing with your tax planner or your financial planner each and every year. The most successful retirees don't just rely on saving early, they take advantage of every window, every rule, and every strategy available. That's what rich people do. If you're 60 to 63, 2025 is your year. Let's make sure you're not leaving an opportunity on the table. Download our free Savvy Investor Retirement Summary or book a discovery call to see how this fits into your long-term plans, and we'll see you on the next video.